Greetings, everyone, once again. Welcome to In the Know. Today, we're going to change things up a bit. There has been a lot of exciting activity around Bitcoin and regulation and content. And so we wanted to share a little bit of that with you. Now, it is Friday, right before Labor Day weekend. And so Tom Staudt, our COO, we had to pull him off the golf course, actually, to come in and talk about all of the exciting things going on around Bitcoin, the potential outlook for it, given the SEC's loss to Grayscale this week. So you'll hear a little background noise. He is on the golf course, but he was also excited to share some of this news with you. So quite happy to do it, I must say. And then Yassine Elmandjra, who is our crypto lead, is going to share some of our content with you, and preview some of it. So we wanted to share with you up front, and then I'll be back for the usual drill.
Thanks, Cathie. It certainly has been a momentous week in the news for the cryptocurrency and the exchange-traded fund industry, with Tuesday's announcement that the SEC lost its court case against Grayscale. I think one of the things that is important to talk about is exactly what was said in that announcement, in that judgment. First and foremost, the courts did not say that the fund has to be allowed to convert to an ETF, nor did it grant that approval by itself. It simply said that the SEC has to go back and review its ruling on that fund. So that's, we saw certainly the price of Bitcoin jump up on the announcement, a lot of excitement. We've since seen that come back in. Part of that coming back in was also that in the same week, later on Thursday, they delayed some applications for a few other funds that had also filed for that, which is not unexpected. It's been consistent from the SEC as they say that it's appropriate to designate longer period of time with which to consider the actions and the rule changes put in front of them. Again, this has been consistent and ongoing for some time, not necessarily related to the Grayscale ruling, but of course it comes in the same week, and Bitcoin price did pull back a little bit on that news. Relative to what happens next, I think there's a lot more questions than there are answers in the market. The SEC does have an avenue with which to appeal this decision. We don't know if that's something that they will do, although they have appealed certain court cases that they've lost in other cases recently. We also don't know if they choose not to appeal, what the timeline is yet for the decision. Some have speculated in the market that one avenue available to the SEC is further denials for other reasons. Others have speculated that an avenue available to the SEC would be to actually unapprove other products that they had approved to get in line with this ruling. While we think that that might be unlikely, it is one potential outcome. Probably the most likely is that they are working on timetables and plans for the eventual approval after considerations. But again, a lot of uncertainty at this point. We certainly think from ARK's perspective and from our partners at 21 Shares that this was a big breakthrough and monumental for the crypto industry. We stand by our position that you've heard from us before, that there is a clear need for an accessible way for U.S. investors to gain the exposure to crypto through a regulated spot ETF product. And more than ever, we do think the writing is on the wall that that is coming here in the United States as the regulatory environment, with some help from the courts, continues to evolve. And so we certainly are committed to developing and launching those innovative products with access to Bitcoin. We've made moves towards that end, and we are eagerly standing by to await the next steps, which could come as soon as next week, or a further announcement from the SEC on what its intended next steps are. But of course, there are no assurances relative to any outcomes or timelines at this point. And I think the most clear thing to say is that issuers of all kind, including ARK, are standing by at the ready for the next word from the SEC. So relative to the fundamentals, I think Yassine is going to add more to that and has some color on what he's been seeing in light of this eventful week of news for Bitcoin.
Thank you, Tom. So with all the chatter around a Bitcoin ETF, we continue to remain focused on putting out Bitcoin research and thought it would make sense in this episode to give a rundown of some pieces you should all be on the lookout for. Starting with the Bitcoin Monthly. So every month, the ARK Crypto team publishes an in-depth presentation detailing our views of the Bitcoin market. So with the first of the month here, you can expect to receive August's edition early next week. Bitcoin's been trading between a tight band of around $25,000 and $29,000 for the last several months, with volatility dropping to a 6-year low. And so in this edition, we break down basically Bitcoin rejecting its 200-week moving average, despite the news around Grayscale and the ETF chatter. And as you'll see in the report, while we have seen that rejection of the 200-week moving average, there isn't really anything that indicates weak holder behavior. We're seeing that the market on average is still trading at a profit and that fundamentals do remain strong. That being said, there are some critical levels of resistance that we highlight that we'd like to see Bitcoin break through for that continuation of a bull market. One of these levels is Bitcoin's on-chain mean, also known as active investor price, which currently stands at around $29,500. The on-chain mean is calculated by dividing the cost basis of investors by Bitcoin's active supply, and is actually a brand new metric that we developed collaboratively with Glassnode that was first featured in a recent Bitcoin white paper that we published last week, Coin Time Economics. And in that piece, we introduce a framework to assess Bitcoin's economic state based on a new fungible economic unit of measurement called the coin block. Now, the coin block basically accounts for the fact that the importance of a single Bitcoin varies based on the time it was last moved. So, for example, a Bitcoin that's unmoved for 10 years will likely hold greater informational value than one that's been unmoved for a week. So to account for this reality, coin blocks, which is the foundation of coin time economics, is used to model Bitcoin's economy instead of outstanding supply. We highly encourage you to read that paper. You can download it at ark-invest.com, and you can also view a live dashboard of all of the metrics that we launched, including the active investor price on Glassnode's website. Finally, yesterday, Cathie and I recorded the second episode of the Bitcoin Brainstorm, which is a monthly conversation with Bitcoiners around the globe, hosted by ARK and Bitcoin Park. And in this episode, we talk Bitcoin and AI, which is a really compelling convergence between two of the 5 technology platforms we're focused on. Now, the introduction of an internet-native financial system, which is epitomized by Bitcoin, is catalyzing a massive shift in how financial transactions online are perceived and executed. And with the rise of AI agents, this shift is enabling a much more efficient allocation of resources. So in this conversation, we dive into how the convergence of AI and Bitcoin hints at a future where AI agents can operate with an extremely high degree of autonomy and efficiency by leveraging an open, transparent, decentralized network like Bitcoin. So you can envision a world, and we get into examples where AI agents are able to make real-time decisions without the need for a centralized gatekeeper and all the uncertainty that arises with participating in the traditional financial system. And given the nature of Bitcoin being free of counterparty risk, having a fractional value system and very strong settlement guarantees, you're able to create microtransactions where AI agents can be programmed to conduct tiny, instantaneous transactions with finality to negotiate and transact swiftly, to bid on opportunities in real time, and basically completely automate the entire agent workflow without relying on traditional settlement rails. So in this conversation, you're going to hear from the CEO and founder of Stackwork, Paul Itoy, the CTO and co-founder of Lightning Labs, Laulu Santakan, and the head developer and product support of Fedi, Cody Lowe. So that conversation will be out next week. Stay tuned. You can subscribe to our YouTube channel, stay up to date with all the latest research by also subscribing to our newsletter at ark-invest.com. And with that, back to you, Cathie.
All right, Yassine and Tom, thank you so much. As you can tell, we're really excited about some of the breakthroughs in the regulatory landscape when it comes to crypto, and equally excited, more excited about the research that is taking us to places that others are not yet exploring, like this convergence between Bitcoin and artificial intelligence. I was blown away by the possibilities. So we're looking forward to releasing that next Thursday. Okay, on to the usual, and I'll speed it up a little bit because I know Tom and Yassine took some of the time. Appropriately so, but we'll go into fiscal policy, monetary policy, economic indicators, market indicators, and then just a little bit more about innovation. Okay, so fiscal policy. What do we have to look forward to? Well, now the topic is potential government shutdown if there's no agreement on the budget. And just like with the debt ceiling, this is going to work out. We're moving into an election year, and no one wants to be seen as disrupting the government and bringing that kind of attention during an election year. So there'll be a lot of saber rattling, but we'll probably land at something in and around September 30th. And then this week, we got some clarification. The IRA, the so-called Inflation Reduction Act, which we do not believe that's the reason inflation is going down, but nonetheless, we knew that that this administration was going to target drug prices, and we got the 10 drugs. They're associated with large pharma companies. And it was interesting that the stocks actually went up because most of these drugs, if not all of them, are scheduled to go off patent in the not too distant future. And so their prices were going to come down anyway. So while the administration said that the price declines would be somewhere between 20 and 60% for these drugs, and a lot of them are for the highest spending categories that Medicare is trying to control, heart disease especially. Most of the prices, when they go generic, will drop by 80%. That's what usually happens. Now, there will be more drug price cuts, but they're not going to happen until well after the election. So we don't have to worry about it right now. And if the administration were to change, there may be new legislation countering this legislation. One of the things we are focused on, though, in terms of fiscal policy is if we're right that the economy is going to have a harder landing than most economists and strategists expect, what will this administration do to counteract the bad news during an election year? And I think the bond market is already a bit on the warpath when it comes to fiscal spending. The words "out of control" seem to be bandied about constantly in the press, and I can't imagine there's going to be another layer of spending. But it is a risk. It is a risk, and I think the bond market will not take too kindly to it. Monetary policy, very interesting from Jackson Hole. So the Jackson Hole Summit is where the monetary authorities get together. And the most interesting word I heard out of it was Powell's use of the word restrictive and saying that the real interest rate was well above the neutral rate. And that defines restrictive. So half of the solution is understanding the problem. If the economy weakens as much as we think it's going to, The Fed is now getting into the mindset with the use of that word, and we might see a pivot faster than might ordinarily be the case. After all, M2 is down roughly 4%. It has been down on a year-over-year basis for 8 months, and it actually peaked 1 year ago. And as we've said many times, this has not happened since the 1930s. The yield curve is still inverted, roughly 70 basis points, and that's a harbinger of slower than expected or lower than expected inflation, or both. And we think both will be the answer there. And the yield curve has been inverted for a year now. Now, many people are probably sick and tired of this talk about any landing. You know, they're hearing soft landing, hard landing, and most are thinking it's soft landing now. We are thinking harder landing, but how hard? It's probably not, it's certainly not going to be anything like 08, 09. Why? Because we've been in a rolling recession for about a year. As you'll recall, in the first half of 2022, GDP was negative for 2 consecutive quarters. Technically, that's the definition of a recession, but we don't know when the NBER, the National Bureau of Economic Research, is how they're going to characterize this. We won't know for 1 to 3 years, I think, after the fact. But we know that that housing is back down to COVID lows. And we know that autos are still in a very soft spot in the 15 to 16 million unit range. 17.5 has been normal, 13 in a recession. So it could go down a little bit more. Inventories, we're hearing in this earnings season, big declines in inventories, especially at retail. In some cases, double-digit inventory declines, so 15%. So that's going to hit in the third quarter. Most retailers report through July. So that's interesting. Now, those are some of the most cyclical indicators or cyclical sectors when it comes to economic activity. Capital spending is starting to weaken now as well. But if we have the most cyclical sectors already having experienced some kind of recessionary condition, this landing is not going to be deep. What is it going to depend on? It's really going to depend on the consumer. And in turn, that will probably depend on the unemployment rate. And we'll get to that in a moment. We did get the employment report today. But if the unemployment rate goes up, then consumer spending, we think, given the very low saving rate, 3.5% now, was before COVID around 8%. So it's down to 3.5% now. And the end of the moratorium for student loan payments, which is in September. That could be a double whammy. So consumption is what's going to determine the kind of recession we're in. And I do believe the consumer is on strike also against price increases. We saw and heard a number of companies in earnings season saying, yep, we probably went too far. Even Domino's said it. We probably went too far. We need to readjust pricing. So many people do not believe we will see deflation in the CPI. We do. Now, I don't know exactly when it will happen, but we're hearing a lot of companies saying, yep, we went too far. The consumer staples companies were increasing prices 8 to 10 to 12% as they were trying to keep their margins in place as units declined. But I think that is turning into a vicious cycle, and they too will have to cut prices to bring consumers back from the more generic brands. So we think there's a harder landing. It's not possible to get a very severe recession given how depressed some of the most cyclical sectors are. But the consumer will take us there. And the Fed will, at that time, we believe, pivot. That could be what changes during the election year. The Fed has been very tight. It was very tight during a midterm election year, and therefore maybe it's been preparing for an election year. This makes the Fed sound like a political organization. It is not, but we do think it was so tight for so long, and shockingly so in terms of the 22-fold increase in short-term interest rates, that it has room to unwind the interest rates pretty quickly as well. Okay, on to the economy. So we did get the employment report today. The non-farm payroll employment was a little better than expected at face value or at first glance, 187,000. But when you include the revisions, down 110,000 in the last 2 months, that netted out at 77,000. That's quite weak, actually. Now, the household survey, again, something for everyone in this report, was up 222,000, but the unemployment rate really shot up from 3.5 to 3.8, still low. But a big increase over 1 month's period. And so that was somewhat surprising. The participation rate continued to move up, 62.8%. And many commentators thought that was a bullish signal. And it is, more and more people participating. But if we're right, this also could be a signal that the consumer is tapped out and needs to either get a second job, or another person in the household needs to get a job. So that could be partly what's going on right now, and we suspect that is. Average hourly earnings were up only 0.2%, so that's 2.5% at an annual rate, though still up 4.3% year over year. If productivity is increasing as we think it is, that means that on a year-over-year basis, the unit labor costs, or real wage gains in this case, could be below 2%, and at an annual rate basis could be close to zero, so very low inflationary ramifications. I know that a lot of people are focusing on some of the negotiations taking place and some of the wild and crazy settlements taking place, and I'll get into that in a moment. But we think that's going to backfire on those companies. Hours worked, the average work week was up 0.1 hours, and so that kind of takes the edge off of a very weak employment growth number. Temporary help continues to go down, though. Those jobs are going down. And so it's all coming into place. It's taken longer, certainly, than a lot of us expected, but it is all working out, I think, the way we have expected. Speaking of earnings reports, it is shocking to see, first of all, on a year-over-year basis, earnings are down, but the top-line growth of many companies is well below the 6 to 7% nominal GDP number. In fact, we're seeing negative top-line numbers out of a lot of the retailers. On a year-over-year basis, their sales are down. So again, probably an indication of how the consumer is feeling. What is helping to make sense about all these contradictions is an identity I mentioned in the last In the Know, and that is GDP growth versus GDI growth. GDP is gross domestic product, so consumption, investment, government spending, and trade, or net exports, and then inventory changes. On the other side of that, the identity, gross domestic income, is simply the various income reports out there, wages, profits, and so forth. And those statistics are more reliable in the short term, whereas gross domestic product gets revised, sometimes quite dramatically around turning points in the cycle. Gross domestic income does not, or is revised much less so. So what we've just learned with the release of the GDI is that the gap between real GDP growth on a year-over-year basis and real GDI growth on a year-over-year basis has never been this wide. It was 2.5% in the first quarter, and we thought, okay, this will close. This is going to, we're going to find out, how weak is weak when the second quarter is reported. Well, second quarter GDP was, in real terms, was up 2.5% on a year-over-year basis. And the GDI year-over-year growth rate in real terms was down 0.5%. So the gap widened to 3 percentage points. It has never been this wide. It right before 0809, it was 2.5%, and in the early 80s, it peaked at 2%. That's a harbinger of something. And we do think that the real GDP growth is going to be revised down quite dramatically in order to make sense of what's gone on. And that recession, the two consecutive negative GDP numbers in the first quarter, we would not be surprised, first half of last year, we would not be surprised to see that extended. A lot of the GDP numbers over the last year revised down. So we'll see what happens. And the other thing that's happening is velocity growth on a year-over-year basis peaked in the first quarter and is slowing down. Now, it's still at a high rate of change. It never got back to the downtrend that has been in place since 1997. So that downtrend is very much in place. And in a recession, it will go down. Again, it's all about the consumer. We shall see. And now about those wage gains and inflation indicators, they're all coming down. M2 down nearly 4% on a year-over-year basis. Gold is down from its peak. In fact, its peak was August of 2020. Commodity prices are down on a year-over-year basis. PPI is up only 0.7%. So this is the pipeline here, 0.7%. All of this is going to feed into the CPI, which is up 3.2%, the PCE, which is up 3.3%, and the core PCE, which the Fed pays a lot of attention to, 4.2%. So we do think that inflation will drop below 2% on all of these measures within the next 3 to 6 months. Now, what about these wage gains? The 10% per year over the next 4 years out of the auto industry or auto supplier industry, or the UAW, the airline industry, UPS. Many people say, oh, because of that, we are in a 70s style inflation, so cost push inflation. We disagree entirely. We believe that the resolution here is not wages pushing through into prices, but wages hitting margins. So we think those industries and anyone settling for very high wage rates is going to experience serious margin declines and profit disappointments. Auto industry has to, in the midst of this, also adjust to the consumer preference shift towards electric vehicles and then autonomous, so away from human-driven to autonomous. The airline industry, we think, as autonomous vehicles take off, we believe, and you can find this in our Big Ideas 2023, we believe that 60% of the short-haul airline business is at risk because of autonomous travel. And as I mentioned before, staples companies are, to the extent they push through big price increases, are now going to have to unwind them. And if they don't, their unit volumes will continue to disappoint, which unit volumes, most manufacturing companies, in order to preserve productivity, want to keep those manufacturing lines going. So that's interesting. Now, innovation solves problems. And if margins are going to be under pressure, the deflation associated with innovation is going to prove quite helpful. So AI training costs dropping 70% per year give us examples like Zoom in a presentation yesterday said that in the first quarter that it has used its chatbots to take the place of human beings in its call centers, it has found that it is able to hand 93% of all the calls placed into its call center to these chatbots and save 500,000 hours of human work. So that is going to be very helpful to these companies who are facing margin pressures. And it is going to accelerate the shift towards these new AI tools. And I know Zoom has faced a lot of criticism. Certainly we have, in terms of our strategies and our belief in its staying power. It's not just a COVID company, but here it is enjoying astonishing productivity gains and is going to help others do the same. Now on to markets, the market indicators. So in the last month, the best sector has been energy. Energy prices have gone up. We got some data from Saudi Arabia today, or on Saudi Arabia and Kuwait. Their exports have collapsed. They've gone from, in the case of Saudi Arabia alone, I think roughly a 7.5 to 8 million unit barrel range down to 5.5 million. I mean, that's unbelievable, especially because at these prices, even at these prices, it was break even at the prior level of production. So it's probably in a deficit position, and we're marveling at the prices it's paying to attract sports franchises. So, that's a big disconnect out there. Nonetheless, energy sector was the best. And, if Saudi Arabia is going to normalize its production schedules, which it will have to pay for all these sports franchises, we believe that energy prices will come down, especially as electric and autonomous make their way into the system. Healthcare and communication services were the next best. And while energy was up, healthcare and communication services were down. On the other side of the ledger, interest rate sensitive stocks and categories were hit hardest, utilities and real estate, because the 10-year Treasury yield, because interest rates went up. The other category that was down, and this is surprising when the market is in a weak spot, consumer staples tend to outperform. They did not this time. And I think it is because of what I've mentioned about their pricing power, at least the power they thought they had, really diminishing quite significantly. In the beginning, the market is beginning to understand that. Fixed income, as I mentioned, interest rates went up, hurt those interest rates sectors, but it was a really important test. We really didn't make it past the peaks from October of 2022. Now, what is the similarity between now and then? Back then, the Chinese yuan was depreciating at a rate that the Chinese government did not like. And so it started selling our bonds, and its reserves have actually been going down. Its dollar reserves are down from a peak of 1.2 trillion to 834 billion now. And the reserves are dropping 10 to 20 billion a month. We believe that this last month, which is when the yuan went back to the level where it was last October, that the PBOC was selling its dollar reserves aggressively in order to get dollars to support the yuan. And so we wouldn't be surprised to see a very big drop in those foreign exchange reserves. So, and Japan is doing the same thing. It did not like the level to which the yen had depreciated, 145 to the dollar. And so it too has been selling. So there have been some big sellers in the market: China, Japan, our own treasury, to support fiscal spending. And yet it was not able to crack that 435 level from last October. That was very bullish. It got down to the low fours with this morning's employment report, and now is backing up a bit to 417. But so we're still in this testing level. We think China is in a world of hurt. The depreciation of the yuan means that the purchasing power of the yuan is diminishing, which hurts their consumer. The consumer, we think, is already feeling a very low level of confidence because property prices are still falling. And these real estate companies, so Country Garden and Evergrande, they are still defaulting on debt, and it's reaching the headlines. Why is this important to the consumer in China? 70 to 75% of their savings is in the property sector, and very often in empty apartments. So not a good thing for confidence. As far as the other news in the fixed income realm, I mentioned the yield curve earlier, still inverted, but spreads, so the difference between corporate interest rates and the government interest rates, those are well behaved. It doesn't seem like there's a lot of stress out there, or that fixed income investors are noticing it. But stay tuned. If the consumer gives way, those spreads will pick up. Commodity prices in the month were flat on average. Bitcoin price was down. There was a lot of excitement after BlackRock filed for a Bitcoin ETF, shot up from 26,000 to 30,000 and just came back down. It got a little excited when the SEC lost its case against Grayscale, and then came right back down when the SEC basically did not approve the Bitcoin filing of Invesco and Wisdom Tree. So that was interesting. And then just a few more points on deflation. There's bad deflation, and I talked a little bit about that. If companies have taken their prices too far, those will unwind. and that will probably hit margins. And certainly monetary policy has set us up for a lot more of that, because M2 is still declining on a year-over-year basis. The full impact of monetary policy today will not be felt for about a year. So we think the bad deflation could move into next year. But as I mentioned before, that severe margin pressure will attract or will encourage more companies to adopt innovation. Innovation solves problems. I mentioned artificial intelligence, the Zoom example. AI training costs are dropping 70% per year. Robotics. Robotics is an antidote to some of these very high wage agreements. And we think there will be a lot of attrition, and robots will take the place of a lot of people. And robot prices, industrial robot prices, for every cumulative doubling in the number of industrial robots produced, meaning 1 to 2, 2 to 4, 4 to 8, and so forth. That's the cumulative doubling. Industrial robot costs drop 50%. And then energy storage in the auto space, for every cumulative doubling in electric vehicle sales produced, drivetrain battery pack system costs drop by 28%. And then we'll end up at Bitcoin, which is where we started today. And as you will hear in this Bitcoin brainstorm, and same with the very first Bitcoin brainstorm that we did with our partners at Bitcoin Park in Nashville, one of the biggest opportunities out there is to eliminate a tax on all purchases done through the traditional financial system. And there's a tax on those unless you're using cash. And the tax is somewhere between 2.5% and 4%. That's a pretty big tax in terms of using debit and credit cards and other intermediaries. These intermediaries are going to be disintermediated by the convergence between Bitcoin and artificial intelligence. And as I started out saying, and I'm sure, and Yassine featured as well, you'll see how provocative this is going to be, and how you should all, to the extent you own businesses or are part of a team that has a lot of responsibility in running your team and running the operations, you have to listen to it. It gives you a glimpse at how provocatively the world is going to change, and especially the traditional financial world. So with that, I wish you a happy Labor Day if you are listening to this weekend. And if not, I hope you all had a wonderful Labor Day weekend with family and friends. So thank you, and see you next month.